One of the most common mistakes I see from first-time homebuyers as well as first-time investors is trusting information like a mortgage calculator online when trying to determine what a monthly mortgage payment is going to look like on the property that they're interested in buying. What they don't realize is these mortgage calculators and this information is missing pertinent information, which is then going to cause them to feel house poor and feel like they were cheated once they actually go to buy that property. Hey, I'm Josh, and I help home buyers make smart financial moves, not build financial stress. Today, I'm gonna show you how to calculate your real monthly mortgage payment and how to avoid one of the most common traps in buying a house. Here's where things go sideways for most buyers. They will jump on Zillow or a mortgage calculator, and they're going to plug in the home price of $300,000, $400,000 of the property that they found online that they absolutely love. They're going to see a number there that's not broken out, that's not giving any explanation, and it's going to look great for them, and they're going to want to pull the trigger. They're then gonna call up the real estate agent and say, I found the perfect property, let's go look at it, let's write an offer, and let's do this. They're then going to love the property when they see it, they're going to put down the earnest money, they're going to get it under contract, and they're going to send the contract over to the loan officer, and he's going to give them their true monthly payment, and crap. It's far too much for what they're actually wanting to pay. The monthly payment on these calculators looks affordable, right? Here's the problem. Most online calculators or information are only going to show you a principal and interest payment or assume that you're putting 20% down when that may not be the case or option for you buying that house. These calculators are leaving out pertinent information that makes up a mortgage payment. And a mortgage payment is made up of multiple different things such as a principal and interest, a homeowner's insurance policy, property taxes on the property, any PMI, private mortgage insurance, and any HOA associated to the property. One thing that you do have to note is the HOA is paid separately from a mortgage payment, but it is calculated into your qualification for the property overall. So when these home buyers get to their actual monthly payment, they're realizing that the payment that they calculated online is hundreds of dollars less than what is the actual monthly mortgage payment. Your monthly mortgage payment is going to be far higher than what you're seeing online. And by the time they've seen it, they've already gone under contract, they've put down their non-refundable earnest money, and they are stuck. There's obviously ways to get your earnest money back and to get out of this situation, but who wants to get this far into the process of a house that they love with not actually understanding what the mortgage payment looks like? So let's break down what the formula looks like for a full PITI mortgage payment, or principal, interest, taxes, and insurance payment. The first letter is P and it stands for principal. This is the portion of your payment every month that is paying down the loan balance that you owe to your lender. I, the next letter, stands for interest, and this is what you are paying to the lender for giving you the loan. The principal and interest payment is usually and typically what you're seeing online, which is going to be a far less payment than what you're actually going to pay towards the end. The next letter, T, stands for taxes. This is the property taxes associated to the specific property that you are purchasing. In Arizona, it's typically around an average percent of 0.6% of your actual purchase price. So on a $400,000 purchase, that's about $2,400 a year, which comes out to about $200 a month associated into your monthly mortgage payment. And I stands for insurance. There's two types of insurance on a mortgage loan. One stands for PMI, or private mortgage insurance, which is the lender's insurance in case of default. Now you can eliminate this by buying it out on conventional, so putting 20% down, or buying it out altogether by paying a larger lump sum, or on FHA. In certain circumstances, it will fall off after about 11 to 12 years. But in most cases, the best way to get rid of PMI is to go conventional financing or to do a non-qualified mortgage purchase. The other type of insurance is your homeowner's insurance. This is going to be the insurance for your personal property. The way I like to explain it, what I've heard over the years from insurance agents, is take that house, pick it up in your hands, and flip it over. Everything that falls is going to be covered by that insurance. Now that insurance policy is going to be associated to your monthly mortgage payment as well. So if your homeowner's insurance policy is $100 a month, you need to associate that into your actual monthly mortgage payment. So that's what PITI stands for: principal, interest, taxes, insurance. And all of these things make up a monthly mortgage payment. Now, one thing that you need to notate is there's going to be what's called an escrow account. An escrow account is a hidden savings account that takes the policies for your homeowner's insurance, your property taxes, and your PMI or private mortgage insurance, and takes each of those portions that you pay out of your payment. So every time you make a monthly payment, that monthly of $100 of insurance and taxes and whatever it may be is taken out of that payment and put into a hidden bank account called an escrow account. And then every year when these policies become due, that escrow account is going to pay those policies for you. Now, there is a way to eliminate an escrow account and to pay these separately. A lot of home buyers opt into creating this escrow account because it's easier not to actually manage all of those payments separately, and the mortgage gets a little bit stickier when you actually do something like that. Now, the last thing to consider is the HOA. Now, the HOA is not associated into your monthly mortgage payment, but it is something that you have to assume when you're making that monthly mortgage payment. You know, if your HOA is going to be $100 a month, that has to be paid. And if you don't pay your HOA, you can be in default on your actual mortgage in your house and get it taken away just by not making an HOA payment. So you need to actually factor that into the total monthly mortgage payment when calculating numbers. If you want to avoid a situation where calculating the monthly payment is too complicated or you're not able to do it on your own, communicate with your lender or reach out to somebody like myself in order to calculate that exact monthly payment on the exact house that you are looking at. A lot of the times your real estate agent is not even able to calculate this accurately unless they are working alongside their loan officer. So make sure everybody is communicating all together to make sure you, as the home buyer, are comfortable with the monthly payment of the house that you're buying. Again, need help calculating a realistic monthly mortgage payment on the house that you love? Drop a comment below or schedule a time with me using the link in the description. If this video is helpful, please like and subscribe. Thank you so much for watching. I'll catch you on the next one.